It's difficult. I mean, obviously, a lot of comparisons are being made. Initially with that, this is a health crisis, and so we were first looking at SARS, and then it became very clear that this was a health crisis of a much larger, going to have a much larger impact to the global economy. And of course, it's slightly different from the financial crisis in that the problems are directly with companies, and demand and simultaneous demand and supply shock are not, a problem with the banks yet.
I want to ask you about the amount of debt that's now being thrown at the system. The view is from policymakers that there's no point penny pinching at this point. The system needs help. Let's just open the taps and stimulate. But if you look at the US Treasury market, there have been some concerns that perhaps debt levels might be moving too rapidly. You've seen that spike in the yield, for instance, the US 10-year Treasury yield. In Italy, we've seen some strains in that market as well. Do we need to be concerned about bond vigilantes at some point when we're throwing so much money at the system for what a lot of people say could be a short-term problem?
Exactly. I mean, if you think about economies that are in lockdown, they're going to have short, sharp recessions, but yeah, come back fairly quickly. But in terms of getting businesses and households across, we talk about these bridging loans and loan guarantees to get businesses to survive in that short-term period. We do need a lot of money thrown at the system, and what we're seeing is those economies with high debt levels, particularly that don't have their own central bank, i.e. Italy, they are looking slightly more vulnerable. But in this case, it is needed.
Piya, I'm doing a lot of comparing 2008 and 2020 today just because of my juxtaposition near the old European headquarters of Lehman's at 25 Bank Street behind me. And one thing I keep hearing is that the banks are safe, the banks are solid, the banks are not the problem this time, they can be part of the solution, to quote Mark Carney as well. But how safe can the banks be? And I don't want to get anyone in terror where there isn't a terrifying story. But the fact of the matter is everything we're talking about is talking about increasing counterparty risk for the banks and potentially scything off their business model and hurting their net interest margins as well. Just how safe are the banks this time round? Exactly.
I mean, banks are a lot better capitalized than previously. They've definitely learned a lot of lessons from the financial crisis. They're hit with this double whammy. So, lower interest rates from central banks means they're hit on the net interest margin side, and also if you're a bank, why would you lend at this point given the default risk? So it's a difficult situation for the banks. It's very difficult to say how much the risk is really going to be taken from the individual companies to banks, and what governments are trying to do is effectively say no, the governments will take the risk.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.